Welcome to Markets Now. I'm Michelle Rook along with Bryan Doherty with Total Farm Marketing. Another higher day, sharply higher day in the grains with livestock futures mixed. And Bryan, let's talk about the grains. We continue to put war and weather premium into those grain markets, don't we?
Yeah, we sure do. It's been a quick pivot from the 581 low December corn had just several sessions ago. This is weather related, it's war related, and it's risk on related. Stock market continues to push higher. You've got energy prices trading in crude oil, a solid five, if not $7 higher than the recent lows. And so you've just got a lot of money flow back into items that have risk. And when I say risk, I'm talking about production risk, in particular row crops, where the 6 to 10 and 8 to 14-day forecasts, they continue to call for extended heat, warm weather, and only at best normal rain to below normal rain for most of the Midwest. So those farmers that are lacking moisture, which is a lot of them, are really kind of on pins and needles here. Farmer selling, hedge pressure, that type of thing is very minimal at this point.
So let's talk technically December corn closing above the 100-day moving average. So where do you think we project to now?
Yeah, so we're kind of right in the middle of the range. So the recent range is 581 to 630, basically $1.50. The midway is about 555. If we can push through 555 and close above that level, then I think you've got some resistance around that 575 to 580 area. We get through that, then you got the obvious at $6. The most recent high 630, 637 and three quarters, the high from last October. So you've got a lot of things there that when you look at big picture all look to me like this market, if it gains momentum, will not take very long for prices to get to those levels. The key is the weather. The secondary key is the backdrop of the Gulf and how long this standoff or war continues to suggest little or no export activity.
I also have to ask you though, the funds went short last week in the corn market. Are they covering those shorts and will they go long?
I think they have to cover their shorts because they're getting beat up pretty quickly here. And so not only do we see short covering there, but we wouldn't be surprised if they go long because we're going to start tripping through some points again where long, you're either long or wrong. And the funds are notorious for pushing the market too hard in one direction or another. So you think about it, they probably pushed it too high to 630. The market flipped over, then they went short. Then they get too short. Now it's flipped back the other way. Now they're probably too short. They're going to cover these. But if we get a fundamental weather concern, if this follows through, they will likely add to positions. End users will add to positions. Speculators will add to positions. Short covering ensues. Buy stops are triggered. All these things are happen when they carry momentum upward. But the backdrop of it is perceptively a supply concern if you're talking lower yields, and that's I think that's on everybody's mind this week.
Absolutely. And the balance sheets are even tighter for soybeans. It looks like the extended forecast, hot and dry, pushing the soybean market above the $14 mark. Again, how high do you see us going? How much weather premium do we need to put in?
Yeah, well, let's go back to the USDA report. We saw a big cut in exports, 300 million bushels. They carried in 25 million bushels, and they didn't change the yield on soybeans. So to me, they kind of kicked the can down the road, maybe said, hey, with less acres, those are fringe acres. Well, they pushed over into corn. And so we took some yield off of corn. It almost looks like the USDA didn't really change yield on crop progress numbers and crop ratings, but kicked the can down the road. And it looks like the bean market, didn't buy their argument. They said, well, you might cut exports, but that yield number is probably too high given the weather itself and given that 13, 14% of the bean crop and corn crop are rated in the poor to very poor categories. Those are categories you can't ignore this late into the growing season. So with beans pushing back above 14 or closing above $14 today, very impressive. I don't want to say sky's the limit, but the market likes to buy beans 14.50, then $15, get new crop beans priced to where the old crop contracts were. That seems to make most sense to me at this point.
Yeah, I was going to ask you about corn and soybeans in particular. Here, we'll talk about wheat in a moment. But how much do you hedge at these levels?
Well, that's a great question. So on the one hand, I'm going to talk about outlook and the what ifs and possibilities. On the other hand, as a farm manager, your operation depends on you to make good sales. So when you get good value in sales, $14 a bushel is a good sale. My bias would be you sell into the rallies. I've never heard anybody, really complain or go broke telling me they sold into rallies. So trigger sales into the rallies, get to the comfort zone. You're deep into the growing season. You can see what your crop looks like. You don't want to get too far over your skis, but certainly 10, 20, 30% reward to this rally. Remember, November beans were at 1130 not too long ago. So they've really put on a good push here. It's impressive. Continue to sell into it. If need be, cover it with some kind of a call or bull call strategy, something where you can have a balanced approach. If you don't like the selling, then start looking at put options to put a floor in the market.
You bet. And the wheat market had a really strong day here today. Again, we talked about the war premium that's being put in there. Same question though, how high do we go and when do we make sales?
We've talked, great question, war premium. I'm not sure we make sales here, even though it's really tempting, or we maybe should reward the market with some sales. But wheat prices are still trading well below where they were just several weeks ago, and well below where they were several months ago. So when you look at putting the war premium back in, looking at some of this heat in the northern hemisphere, the Canadian crop likely getting hampered by some of this dry weather as well. I'm not so sure the fundamental picture in wheat is really reflective of where the price maybe should be, and that's
Okay.
pushing wheat another 50 cents, a dollar higher, factoring more uncertainty, in particular this war premium. That's a really big deal right now.
Absolutely. Okay, cattle market. We did close higher in live cattle futures despite lower feeders and higher corn market, so that's pretty impressive. We did make some new contract highs. Do we keep going here? Is this market trying to build in anticipation of higher cash, or what is it?
Yeah, well, it's for sure higher cash, higher anticipation of tight supplies, or higher prices anticipating that supplies remain tight. We've talked about this for some time, but I'm even impressed with this. We've kind of argued that we got a pretty big signal here several sessions back, big reversal on the charts, hook reversals, and yet here we are crawling back in the new highs. Boy, I got to tell you, it's impressive. It's textbook, but I'm worried about kind of taking the stairs up and taking the elevator shaft down in the market. We've been up for so long, and the expectation is demand is just going to continue to be there. I'm not necessarily enamored with the overall economic environment that I see not only domestically but worldwide. Stock market's been on a run, but stock market isn't necessarily indicative of the economy. I'm worried about consumers just not having enough dollars stretched far enough to afford this high priced beef. So be very on the alert. But right now, trends higher. This is what we talked about with these droughty conditions the last 3 years. There's going to be a loophole in this year where we just don't have enough cattle to meet the pipeline, and here we are. Yep.
Milk market, let's end on that, Brian. Just slightly lower day here today. The July contract, unfortunately, we're under the $14 mark there, but on a chart, the back months, the deferred contracts look like they're starting to turn the corner. Is that right?
They're starting to turn the corner. We saw good cash activity this week in the cheese trade. We've seen a number of signs that producers are marketing more dairy cows. We get high beef prices. That should send those cows to the pipeline a little sooner. And so when you look at and you step back and look at the big picture, it's hard to always pick a bottom. But when you look at the dairy industry, I think it's suffered from a lot of things. One is its own success. Farmers are very good at producing milk, and when prices slide, they produce more milk. We're in phase three right now. This is the liquidation phase. This is where you really take stock of higher corn prices and meal prices, and you really trim back on the herd. You have to do that. The market is seeing signs of that. I don't want to call a bottom, but I wouldn't be shocked if the bottom's in place. And that's a market where there could be speculative interest just waiting for a home to find money, or find a home to put money into and push prices higher.
Yeah. Has there been enough culling so far of inventory or of the herd to really have a rapid response, or is this going to be a slow go?
And most likely it's a slow go. And here's my rationale on that. The size of the dairy producer has grown and grown and grown, so you don't get this rapid reduction. I'll give you an example. If we had a neighbor that milked 100 cows several years ago, he might have been very quick to get rid of 5 to 10% and slim back a little bit. For him, it's 10 cows. We don't see 10% across the board in the industry. These are heavily capitalized, large operations that have been probably well insured. Risk management has been strong. But even after all of that, you've got this lull in prices here that just doesn't make it pay, particularly with corn or meal prices moving higher. So the response will be slow in coming, but there will be a response. It's the forces of economics, the invisible hand of Adam Smith. It all makes sense. The dairy market is an example of an economic environment where high prices cure high prices, low prices cure low prices. That doesn't change. It's just, I think we extend out the low prices a little bit longer than we have historically.
All right. Always a pleasure to talk with you, Bryan Doherty with Total Farm Marketing. That's Markets Now.